Okay. All right. Let's proceed. So we've looked at agency theory. What are the agency conflicts? We are saying the most important conflict of those mentioned above is the one that is between the interests of the shareholders who own the company and the directors who run it. Agency conflicts are differences in the interests of the company owners and the managers. And the way through which the conflict we are talking about arises as a result of the following. One, what we call the moral hazard. A manager has an interest in receiving benefits. That is what we said their interest from his or her position as a manager. This will include the status, such as company car, airplane, lunches, attending sponsored events, and so on and so forth. And so we are saying sometimes this thing clouds their judgment, right? And they lose sight of why they have been put in the position of what? Of managers of the company. Okay? And so they'll be doing any and everything which will get them to enjoy some of these things, even if it means prioritizing short-term profits over what? Long-term shareholder wealth maximization. And this will create a conflict. I hope that is clear. All right. Efforts level. For a manager, they may work less hard, right? Or they will relent in terms of the effort they are putting into the work if they know that they don't own a stake or they don't have any parts ownership of the company, right? However, if the managers were also part owners or they've also bought shares within the company, then the level of effort they are going to put into the work they are going to do will be much more high. So the effort level is quite lower if the managers don't have any form of ownership within the company. Okay, and that's the effect of that lack of effort, that lackluster, how do we call it? Behavior they show towards the work they have could result in what? Lower profits, and at the end of the day, a lower share price. Because you're not doing what is needed for the company to grow, because you don't feel like you are an owner of the company. I hope that is clear. And at the end of the day, that is going to affect the shareholders in terms of the return that they are going to get. And so this again will pose some level of conflict, because shareholders will say, you are not doing what we put you there to do. Okay, effort level or lack of effort. Earnings retention. We are saying the remuneration of directors and senior managers is often related to what? The size of the company rather than its profits. And what this means is that the managers will now have an incentive to grow the company and basically increase their sales and their assets, rather than to increase the return to company shareholders. The bigger the company, the more benefits the managers are getting. Remember, they are thinking about what they are going to get. And so for that to happen, something like, rather than paying shareholders dividend, they will want to plow back all the profit into the company so that the company will grow, okay, or use it to undertake projects. Maybe the shareholders of the company are looking out for higher dividends. Master, some of them, they are not looking at what the share price will be in 10 years. No, they don't want that. Pay them dividends now. That could be the reason why they bought the company shares. So when we are looking at this point, we are arguing this point from the point of view that the shareholders of this particular company are looking out for higher dividends. And so if you as a company or the directors are retaining, so that is why we say earnings retention, are retaining a larger chunk of the profit, it means that you are not paying them the profit that is due the shareholders. And that will create a conflict. Okay, I know someone will say, but sir, you said shareholder wealth can either be maximized through dividend payment or capital appreciation. Yes, I said that. But we are saying This is a situation where the shareholders want you to pay them higher dividends. Okay, so we said shareholder wealth maximization is through paying higher dividends or retaining the money, plowing it back into the company so that your share price appreciates, or a combination of the two. So it means that there are some who want dividends, there are some who want capital appreciation, and there are some who want both. So you should ask yourself, as a shareholder in any company or a prospective shareholder, what would you want? Okay, once you're able to define that goal, so this is a free financial management or a financial advice I'm giving to you. Once you're able to define that goal, then it will be for you to research on the company shares you want to buy or the company you want to buy its shares and check whether they pay dividends, okay, or they're a company who doesn't pay dividends. So you don't just buy any company shares. Do your research, okay? Do your research. All right. So that's about earnings retention and how it can create conflict. Time horizon. We are saying for shareholders, they are looking at what? The long term. Managers, on the other hand, may be what? May be interested in the short term profitability of the company. And so you can clearly see that the time horizon for these two groups of people doesn't align. And if it doesn't align, it means that the manager who is interested in the short term will take decisions that will benefit the company in the short term and himself in the short term. However, that will mean that in the long term, shareholder wealth maximization might suffer. I hope that is clear. And that is what the time horizon basically what it's talking about. So there should be an alignment between what these two parties. If not, it creates a conflict. All right. Please, I hope all the points are quite clear. All the points are quite clear. Okay. Let me see an emoji to testify to that, whether everything is clear. Okay. So, yes, a conflict exists. What can we do about it? We are saying the owners of the company cannot sit aloof and then just watch this conflict kind of emanate. So we are saying there's what we call the agency cost. So this will be a cost that the owners of the company will want to incur to ensure that they align their interests with that of what the managers. And first of them will be what we call the cost of monitoring. So you are trying to monitor the activities of the managers. And that can be done through what? Requiring them to prepare annual financial reports and then getting them what? Audited. Okay, so the shareholders pay for this thing. They pay for it. I hope that is clear. So that is one way they can monitor what the directors are doing. Two, we are saying that agency costs also include the costs to the shareholders that arise when the managers take decisions that are not in the best interest of what? Of the shareholders, but are in the interest of the managers themselves. Very important. Sometimes, like I said, the managers take a decision with a very internal view, right? And they are not thinking of what the shareholders want. So even though they think inherently what they are doing is good, it may not yield the best interest or be in the best interest of the shareholders. The example we have here is that the company may decide to acquire a subsidiary or acquire another company just because they want to accelerate the growth of the company as a whole. But what if they make a mistake in the acquisition of the company? They don't do their due diligence well, and the supposed synergies that they wanted from acquiring that company does not come up or does not materialize. That means you've taken shareholders' money, bought another company, and whatever benefit you wanted didn't come to fruition. You've costed the company, or you've costed the shareholders. You've costed them their money. Okay, and these are the issues. So we are saying when something like this happens, the cost to the shareholders comes from what? A fall in share price. Taking a bad decision will affect what? The company share price at the end of the day. And if there's a capital loss or there's a depreciation in the price of the company share, who does it affect ultimately? The shareholders. And then finally, another cost that the shareholders may get is what we call bonding cost, bonding. So if you want to bond with someone, it means you want to bring the person close to you. Try to let them see your perspective, right? And make them work in your favor. And so how this will happen is that try to let the shareholders also feel as though the company is for them. And so by giving them share options, right, or packages which will include equity ownership in the company, you can clearly see that that is going to what? Impact on their effort level, right? And then they are going to give up their best and then what? Take decisions that they know will not only benefit them as managers, but will also benefit them as well as part owners of the company. I hope that is clear. So that is the bonding cost. And so giving them free shares and so on and so forth is also a cost that the shareholders will have to incur to ensure that they align their interest with that of the managers. Okay. All right. Aside this agency cost that we have raised above, we are saying the ways through which you can reduce the agency problem, right, is to devise a remuneration package for executive directors and managers that gives them what? The incentive to act in the best interest of shareholders. So pay them well. Okay. The directors of companies are one of the best paid people or the best paid employees. Right. So if you pay them well as senior managers, bonuses and all of that, they will do what is best for the company and the shareholders. Secondly, the institutionalization of a board, right? And then when you take the composition of the board, you should also have independent non-executive directors. So it says the board should consist largely of these sets of what? Directors. So we have executive directors and non-executive directors. When you establish a board, we are saying let a larger chunk of the board members be what? Non-executive directors. Why? Because we are saying these independent NEDs have no executive role in the company and are not full-time employees of the company. So they don't take salary. At best, you pay them a fee, right? We pay them a fee or an allowance. Okay. All right. So once you have more of them on the board, they are able to strengthen the executive directors on taking good decisions that will benefit what? The shareholders. So it is one way you can what? Reduce the agency problem. And we are saying independent NEDs should what? Should also take the decisions where there could be what? A conflict of interest between executive directors and then the best interest of the company. And so again, when it comes to the work of the board, we are going to see that there are committees on the board. And by and large, the non-executive directors are the ones who kind of head the committees, right? And so on and so forth. So instituting a board is very good. Why? Because you put a lot of the work when it comes to the board work in the hands of the non-executive directors. And by putting this in their hand, they are able to control what the executive directors are going to do when it comes to their day-to-day work. And that belief is that it is going to, at the end of the day, ensure senior managers do what is best for the shareholders. All right. And so in Ghana, when it comes to the board and its operations, we have what? The code of best practices, right? And then legal documents where you're going to see some of these governance practices being shown are specific sections within the Company Act, right? So within the Company Act, it has some sections that talks about corporate governance or how companies should streamline what their corporate governance affairs. Also, if you're a company who is seeking to list or go public, right, on the exchange, the Ghana Stock Exchange has what? Some listing rules. And these listing rules basically would spell out some very important corporate governance frameworks which you need to put in place before you decide to even come to them that, hey, we are ready to go public or put our shares out there. So I think from December ending last year, 2 new companies have come on board. Who can tell me? One is a bank, and I'm sure one is currently one is this thing. I'm sure they're even about to, so I shouldn't say they are there already. But last year, December 2025 ending, right? And as we have it now, there are 2 companies. Who can tell me which companies they are? One is in the oil and gas, and then one is Star Oil.
I don't know whether they've been enlisted or they are yet to be enlisted in this month.
Star Oil. I haven't seen anything on Star Oil. I haven't seen anything on Star Oil. So the oil company I'm talking about is Zen Petroleum, right? Zen Petroleum. They are the ones. And then for the bank I'm talking about, that is First Atlantic Bank, right? So First Atlantic Bank has been listed. They have gone through all the steps, right, required to list the company, right? So they've issued their prospectus and they've done all of those things. So they are there. But Zen Petroleum are now in the stage where they are doing placing. Okay, so you have private institutional investors buying their shares. Once they are done, it is required by law that they allocate 25% of the shares to the general public. Okay, so when they finally list on the Ghana Stock Exchange, those shares will become public for the rest of the for us to buy. Okay, all right. So that is about that. And so before you are even listed on the stock exchange, we are saying need to follow some governance rules, and then the listing rules by the Ghana Stock Exchange also provides this this framework for companies. Also, Securities and Exchange Commission, right, also have some code of best practices on corporate governance. And so you can also source some important governance frameworks from these documents, okay, as a company. And by and large, we have the OECD principles, right, on corporate governance. And most of the okay, is someone having a problem?
Yes, I think
Yes,
he's trying to join.
Maybe he has not used the email address he registered with. Let me sort that one. That will be the course, okay? So, all right. So let's box on, right? So basically, the OECD principles spells out a number of governance issues, right, that companies will have to take care of. And even in Ghana, the code of best practices also takes a cue from the OECD principles. So with specific sections within the code of best practices, it talks about what the mission and responsibility and accountability of the board of directors should be, right? It talks about the committees of the board. So it spells them out. For any board, you should have a remuneration committee put in place, and you have what we call the audit, and sometimes they have in addition the risk committee, right? The audit and risk committee. These 2 committees, like, they should be there. Okay, they should be there. It spells that out. What the board of directors should do, it spells it out, right? The responsibility that the board will have to the shareholders and other stakeholders, financial affairs and auditing, disclosure of annual reports and the code of ethics. So it spells all of these things out. And so the board, in doing their work, will have to rely on some of these things before or to ensure that the work they are doing aligns in the best interest of of the shareholders. So corporate governance is very, very crucial. All right. So the key corporate governance issues that we are going to talk about, again, are the role and responsibilities of the board. The board basically is there to provide leadership, right? And again, leadership especially to the executive directors. Because remember, the affairs of the board is being paid for by the shareholders. Okay, it's being paid for by the shareholders. And that is why we want a majority of the board, the directors on the board, to be what? Non-executive directors. So that they can what? Provide a second view to what the executive directors are doing. When it comes to the composition of the board, like I've said, or we've earlier said, it should be made up majorly by the non-executive directors. And even when it comes to the chairman of the board, the code of best practices says that that person should be a non-executive director. Okay, the board chairman shouldn't be an executive director, or he shouldn't be the CEO of the company, no, or the managing director of the company, no. Okay, so it spells that out. And then when it comes to the composition, also more non-executive directors. Financial reporting, narrative reporting, and auditing, very crucial when it comes to what? Keeping a close eye or monitoring the activities of what? Of the executive directors. There's a need for them to prepare financial statements. There's a need for them to get it audited. Okay. And there's a need for them to publish it for everybody to see what they are doing. Okay. And the code of best practices spells this out. Remuneration, you can't play with it. Okay, you can't play with it at all. The directors will have to be what? Paid. You have to pay them well so that they do their job well. Okay, and so there's a reason why, like I said, there should be a remunerations committee. They are going to decide the pay to be given to what? Both non-executive directors and executive directors of the company. I hope that is clear. Because payment or remuneration is a very sensitive topic. Once the right amount of remuneration is what is given, it is best believed that it is a fair remuneration that will help the directors what all work towards what achieving the objectives or the aim that the shareholders would want them to achieve for them. So very, very, very crucial. Again, I mentioned risk management, internal control, right? Clearly, the directors should ensure that the company operates within acceptable levels of risk. So when you later learn about it, you get to understand that the risk appetite of the company as a whole is determined by what? By the directors. Or by the so they are so high such that they take decisions that will maybe backfire. And when it backfires, it is the shareholders who are going to lose. Okay. And that will mean that they are not properly using the resources given to them very well. So they need to manage the risk, set the tone in terms of the company's risk appetite. Okay. And be able to safeguard and use the company's resources very, very well. And that comes with what? Having proper internal controls put in place. I hope that is clear. All right. And finally, disclosure. The boards will have to keep the shareholders and other stakeholders in the loop, right? They have to disclose through preparing financial reports and also getting them published or publicated, right? And that is where the disclosure comes in. The belief is that all of these frameworks helps to solve the underlying problem of of the agency problem or the agency conflict. Okay, so if you are tested or asked any questions with respect to corporate governance and the agency conflict or stakeholder and their conflicts, at least you should be able to write or say something in that regard. All right, any question, please? Any questions? So please be aware. What I'll be doing is that I'll be giving you a lot of quizzes. You have short quiz, objective test quizzes. I beg you, actively take a part in it. You just it will fast track your ability to catch up with all the things that we have to do. Okay, so I'll be giving you a lot of them. All right. Any question, please? Okay. All right. So please, just to take you back, the things we are doing so far. This, right? And then we've just touched on this, and then we are about to do this. So please, we are fulfilling the syllabus objectives, right? So corporate social responsibility, very, very important. Okay. CSR refers to the responsibilities that a company has towards what? The society. Corporate, social, society, right? And the understanding that, like I've said many times, your responsibility doesn't only lie with what? The shareholders. No. Okay? All right. It also lies with society and other words, other very important stakeholders. So this is based on the concept that a company is a citizen of the society in which it exists and operates. It's a corporate citizen of society. It owes the same sort of responsibility to society as large that other citizens should owe. And therefore, there's a social contract that exists between what? The company and the society within which they operate. Having said that, we are saying there are some key principles when it comes to what? Corporate social responsibilities. And these 5 key principles or aspects of corporate social responsibility are that a company should operate in an ethical way. So business ethics, right? Operate in an ethical way and with integrity. Don't be seen as a company undertaking dubious deals or going in for dubious deals. Okay, so be ethical and act with integrity as a company. Definitely, you should have code of conduct, okay, for your workers so that they act in the right way. A company should treat its employees fairly and with respect. It's a CSR activity. A company should demonstrate respect for basic human rights. And so, therefore, it should not use or tolerate child labor. Okay, but sometimes this thing, I ask myself, how can we truly do it? Because if you dig down deeply into how materials are sourced for some of our very our gadgets and things that we use, right? Or some of our accessories and appliances and all of those things, or some of our favorite stuff we enjoy, whether being in movies or whatever it is, you get to see that beyond all the luxury, beyond all of these nice things, is some form of what? Human right abuse. Almost always. Because your phone, what is used to make the phone battery, right? The lithium. Where is it sourced from? 80% of it is sourced from Congo. And you should know what is going on in the Congo right now. Maybe people do not talk about it that much. Okay. So when you go to China, they like to produce, we know them as a production hub. Right? But when you go deep down, you get to understand that a major chunk of the workers working there don't work with the best or in the best of conditions. Some of them are even children or minors. Right? So it's a very big problem. We may not see them, but it does exist. But at the very least, if you're a company and you want to show yourself as a good corporate citizen, then at best, your operation should be one that has basic respect for human rights. Do not use child labor. Do not source your materials unethically, and so on and so forth. All right. A company should be a responsible citizen in its community. The responsibility to the community should be shown in the form of what? Investing in the local community through what? Building of schools, hospitals, constructing roads, and did I say roads? Hey, scrap that. The assembly will not even allow you to construct the road. Even school, you have to fight with them. Because someone wants the contract. So Those are the issues. So the road, I've said road again. Yeah. The schools, the hospitals, and so on and so forth, right? The borehole, yeah, you can do it for them. Right? Some of these things you can use to show yourself as a good corporate citizen. The companies will do what it can to sustain the environment. And so a part of your corporate social responsibility has to do with what? Ensuring your operations does not affect the environment. Okay. And so operate sustainably so that the next generation can also have what? Access to some of these resources that you have now and are using for what? For your operations. So when we talk about the principles of CSR, it borders on these 5 things that we have spoken about. And somewhere 2024, I believe, or early 2025, the examiner tested students on what? On the principles of CSR. Okay, the principles of CSR. All right. So corporate social responsibility, a very, very core area. Any question, please? Any question? Okay. I did mention that one of the new areas added to your syllabus is on what? Ethical issues. And when it comes to ethical issues, the core things I want you to always remember, right? And this spans across many of the papers that you're going to write, especially for a professional accountant or a professional financial manager, right? You need to ask yourself, what are the fundamental, okay, principles of ethics that you need to uphold, right? What are the threats, okay, threats to these principles? And then what are your safeguards? Okay, these are the key 3 things when it comes to what? The issue of ethics as it relates to what? The accountant or the financial manager in this respect. We are saying that in your work as a professional accountant or a financial manager, you need to what? Show ethical responsibility, because in your line of work, you will come across what? A number of issues or dilemmas that will confront you. And so you need to uphold what? The principles of what? Of your profession. And what are some of these principles? Let's list them out. You need to what? Show professional behavior, right? Show professional behavior, show integrity, right? Show confidentiality in your work, confidentiality, right? Show competence and due care, okay? And then what? Be objective or show objectivity, right? These are the 5 fundamental principles. And so in your line of work, if any ethical issue arises, let these be your guiding light. So ethical issues and dilemmas may arise in the context of financial management, particularly where financial management relates to making decisions. The professional accountants will ensure that their behavior is ethical at all times, and they take appropriate and proportionate actions in response to unethical behavior by others. So it is not just you, but also if you see your colleague doing something, you need to show ethical responsibility. Okay? Do not allow them to do that bad thing you are seeing them about to do. So what are the ethical issues? They are saying it may arise when it comes to financial management in a number of ways, especially when it comes to decision making, where because of the decision you have to make, you may lack objectivity and be biased. And how does this show up? We are saying, especially if, for example, the company has a project to appraise, right? Or the financial manager has a project to appraise. We are saying you should do that in an unbiased and what? Objective manner. However, it will be what? Unethical or unethical on your part as a financial manager. When evaluating alternative projects, you use more optimistic assumptions for what? A preferred project in order to make it appear more attractive. What this means is that there's a decision to be made on which project to undertake. But because maybe you know that if we choose project A will be given to probably a contractor or someone who I may have close ties with. In your analysis, okay, or when you're conducting your investment appraisal, you use some assumptions which will make project A what? The much more favored project. So if you have 3 projects, we will say choose the project with, let's say, the higher MPV. So project A, because the assumptions you use were so good, it makes project A what? The project that the company will want to choose. And if that project is chosen, you give it to someone that you know you have close ties with. So that means that you are not being objective in the work that you are doing, or the financial analysis or the decision you are taking as a result of what? Of your analysis. And so that clearly shows what? A lack of objectivity and bias. That was what you want to be what? The preferred project. I hope that is clear. So this ethical situation here is that you lack objectivity when it comes to what? Taking a decision. Conflict of interest also would affect one of these key principles. So you see here, we have objectivity. Conflict of interest can also affect your objectivity and also what? Your integrity. When taking a decision, we are saying the professional accountant should not be affected by what? Competing personal interest. Acting ethically in this context will encompass what? Avoiding any potential conflict of interest and disclosing them where appropriate. Your company is about to undertake procurement. You want to procure some goods or some works or services. You clearly know that as part of the procurement team, one of the tenderers or the suppliers is a close relation. And that will mean that it will lead to reduce yourself from the procurement team. Tell them that you don't want to be a part of it. And disclose the reason why you want to what? You want to recuse yourself. Okay? However, if you sit through it, there's a tendency for you, there's that likelihood that you may influence the decision in the favor of what? Of that said close relation. And that will mean that conflict of interest has arisen, and that will affect your objectivity and your decision to take an unbiased or make an unbiased decision. Okay? So ethical situations here, conflict of interest, and that can also affect what? Your objectivity. Bribery and corruption, very important. Did I say very important? It's bad, but it's an important point. Taking or accepting bribes, okay, will mean that you have sold your objectivity, or you have thrown your objectivity out of the wind. And so by accepting the bribe from the favored party, again, let me even use the procurement thing. If you receive bribe from one of the tenderers, it means that you are going to award the contract to them. Okay, so again, it can pose a very huge ethical problem for you as a professional accountant. And therefore, you should eschew it. We are not saying don't receive gifts, but sometimes you should measure the level of gift that you take. So for many companies, the problem will be what gift is acceptable, what gift is not. Cash gifts should be out. Gifts that are above a certain value should be out of the picture. Okay, but let's say pen, coffee mugs, right? So some small souvenirs video sometimes it's allowable. Okay, but at the end of the day, you should be able to what, decipher between a bribe that is going to what in the future make you take a decision in favor of that party, or a gift that is going to what, lead to some form of corruption later in the future. So it's very important that you take notice of this. Okay, so bribery and corruption, huge ethical problem. Competence and diligence. I did mention that as part of the core principles to guide an accountant's ethics is what? Is being competent at what you do. You not showing competence in your work could pass as what? As an ethical problem. You have to undertake a complex investment appraisal scenario. You are not qualified. You don't know what goes into what? Conducting the analysis. What do you think you are going to do at the end of the day? Right? You are basically going to mess up. Your decision you are going to arrive at will not be based on what? Proper skills, right? Because you lack competence. And that could mean that you are going to tell the company's financiers that, hey, I believe this project is going to be what? Viable. And so give me money and let me invest in it. You take their money, and then because you didn't do a good job with respect to the analysis, you use the money for the project, and then the intended results does not come up. So competence and diligence at your work shouldn't be what? Shouldn't be compromised at all. So a professional accountant should conduct financial management in a diligent and competent manner. And therefore, some techniques of financial management can be complex. And a professional accountant should take steps to ensure they do not accept or undertake what? Tasks that are outside of their competence. So if you can't do that complex investment appraisal, don't venture into it at all, because you are going to what? Make a wrong decision at the end of the day. Okay, so basically these are the core ethical issues that could crop up. But like I've mentioned, the fundamental principles should guide us. So there could be scenarios that will mean that you may need to reveal very sensitive information. We are saying because of confidentiality, you do not have to do that. Okay, unless maybe it is required as part of some legal proceedings that you reveal. That is fine. But aside that, do not reveal confidential information. Integrity, I haven't mentioned, but very important. Say it as it is. Don't include anything. Don't remove anything. Report it as it is. Okay. All right. And then professional behavior means showing that you abide by all laws or rules that govern your work. If it is procurement, ensure that you are following all the procurement rules. If it's investment appraisal, ensure that you are following the right technique, and so on and so forth. Okay. All right. Any questions, please, with respect to the ethical issues? Any question? Any question? Prince, are you in now? Okay. All right. So again, this is a new area. I think it has been tested just once, okay, since its introduction in the syllabus. So let's also be very wary of it. Okay, so ethical issues, this one, we have completed that. All right, economic environment, last night. Okay, this was asked. Let me go to that question so that we see it. This is it. Okay, so it says that in July 2025, it's a 5-mark question. So it means that with the area that we are looking at, I want us to get what we are doing. Okay, I said all of this is a 5-mark area. And the 5-mark area came from what? This one. Where is it? This one. This is where the question came from. Okay. Let's read the question, and when we are done with what we have to do, let's see whether we can attempt to answer it. It says in July 2025, last year, the Bank of Ghana Monetary Policy Committee, MPC, delivered a 300 basis point policy rate cut. So 100 basis points is 1%, right? So 300 will mean that what? A reduction, a 3% reduction. So previously it was 28 as of May 2025, and a 3% cut will mean that it has reduced to 25%. All right. So once monetary policy rate has been reduced, there's a name we give it. We are going to learn about it very soon. This followed with inflation easing to what? 13.7% in June 2025, which was what? Down from 18.4%. So the rate of inflation has also fallen as at June 2025. So from 18.4 to 13.7. What does this mean if inflation has fallen? Ghanaian manufacturing firms typically rely on what? Short-term borrowing in order to finance their business. So you are a manager of such a company. What do you think what is happening within the economy? What effect do you think is going to have on your business? And that is the question you were asked here. Explain 3 advantages of the policy rate cut to what? To manufacturing firms in Ghana. 5 marks. Okay, so this was from the monetary policy side. All right, so let's get into the economic environment and explain what the issues here mean. So when it comes to the economic environment, we are basically trying to look at what how government and its parastatals, right, how their decisions affect the economy as we have it. And economic policy will come in 2 ways, right? That will be through fiscal policy taken by the central government, okay? Economic policy taken by the central government, and then monetary policy taken by what? The Bank of Ghana on behalf of what? Of the government. Okay, so clearly you are going to see that what we saw last night was basically from the monetary policy side of it. Okay, and how that affects the economy, right? So we are saying a government uses economic policy to try to influence economic conditions with the objective of what? Achieving sustained growth and full employment of what? Of resources, and also restricting the rate of what? Of inflation. And they do so by what? By these 2 economic policies, fiscal policy and monetary policy. Let's look at fiscal policy and the effect it has on what? On businesses. Then we'll look at monetary policy also. All right. For fiscal policy, like I said, it's from the central government. And their fiscal policy revolves around what? How much they intend to spend, which is government expenditure, how much they intend to raise through revenue, especially through taxation, and if there is a gap between how much they've raised from tax revenue and how much they intend to spend, how they intend to bridge the gap, okay, or supplement that gap with what? With borrowing, whether domestic or foreign debt. I hope that is clear. So expenditure, taxation, and borrowing of the government, how does it affect what? An economy, and to a larger extent, how it affects what? Our business. Please remember, like we just saw last night, we are looking at the effect of the economic environment on our business. Okay, so I just want to say this is not an economics class where I'm just going to learn what is monetary policy, what is contractionary, what is expansionary. No. How does the expansionary monetary policy or the expansionary fiscal policy affect your business? How does the contractionary fiscal or monetary policy affect your business? That is what we are here to do. Okay, so the fiscal policy, which is shown through government expenditure, taxation, and borrowing, affects our companies in a number of ways. One, as a company, you will want to what? Minimize your tax liability, possibly by what? Transferring business operation to what? Low tax countries. Why is that so? The key question is, who sets the tax rate? Is the government. So if the government says they want to raise more money from what? Tax revenue, it means they're going to increase what? The corporate tax rate. Currently it's 25%, right? If they want to increase it, it means they want to squeeze money from businesses. So we call that what? A contractionary monetary policy rate. Fiscal policy. Okay, a contractionary fiscal policy. So they increase the tax rate, and it means that companies will now have to what? Pay more taxes to the government. Pay more taxes to the government. Okay, and so as a company, what this will do is that if care is not taken, it is going to squeeze out more of your profit to be paid to the government. And so you have to what? Put in place tax minimizing what? Activities like transferring a major part of your operations to a low tax country. And that is one way you can what? Avert this, or using other tax avoidance what? Schemes. Okay, all right. So government increasing the tax rate has an impact on your business. Likewise, if government reduces the tax rate, that is more or less trying to expand money flow within what? The economy. And so businesses will now have more money, because if the tax rate is low, you are paying less money out of your company as what? As tax. And you are retaining more money for your company, right? Which you can use for what? Other development projects, or even create more businesses to employ more people. Okay? All right. So the tax can either be contractionary or expansionary. What about borrowing? Government borrowing might affect the borrowing of other companies. As we are going to learn later, where you borrow, or where you as a company go and borrow your debt financing sources, the government also goes there to borrow on the domestic market. Now, the only thing is that you as a private company, the prospective lenders will see you as a risky company. But for the government, they know that the government will not default. Right? So they will give the money to the government rather than give it to you. So we are saying that if companies also want to borrow money by issuing bonds or raising debt finance, for you to get money from the prospective lenders, you will have to what? Offer a higher rate of interest to those people. If the government goes to take money from those same people, the government will pay a lower rate because they believe the government is what? It's more or less a risk-free entity, right? Or a credit-worthy entity. So that means that government also borrowing from the same place you also borrow makes borrowing very expensive for you as a business. I hope that is clear. So you have to pay the investors a higher rate so that they can what? Give you the money rather than putting it in or giving it to the government. That is what we mean. Okay. All right. Changes in tax can also affect the company in a number of ways. If the tax rate increases again, it's going to affect how much dividends you pay to your shareholders. If the tax rate reduces, you can pay out more dividends to your customer, to your shareholders. Right. Expenditure. Where government intends to spend. If government, for example, focuses on the manufacturing sector, spends more in what? In creating an enabling environment for manufacturing companies. I'm just situating it to last dice paper. Government spending there will mean that it is going to what? Boost the manufacturing economy. Okay. However, if government doesn't spend in the manufacturing sector and spends in another sector, it means the manufacturing sector will also what? Face some challenges. So where government even decides to spend has an effect on the business. So these are the fiscal policies that are that can be put in place by the government and how it affects your business. Now let's look at monetary policy and inflation, which was what last night's this thing was on. Monetary policy is a policy relating to what? Monetary issues in the economy. In particular, how we use the monetary policy tools to control the rate of inflation, which in effect affects interest rates and what, to a larger extent, affects what? The exchange rate. I hope that is clear. So once inflation is brought down, it is going to affect interest rates. That's the rate at which the company may borrow or even what invest. And then what? It may also affect exchange rates. Okay? So that procuring or trading with other parties outside of your shores is not so much expensive for you. So this is where your question was coming from. How does it affect your business? All right. So businesses might be affected by monetary policies of the government in a variety of ways. Changes in interest rates might affect the cost of borrowing and hence what? Profit. If the interest rate is high, right? Higher interest rate on long-term finance might deter companies from what? From making new investments. That is because if the cost of raising the money is high, I'm not going to go in for the money. At the end of the day, it means I will not have so much money to invest in what capital projects. And if I don't invest in capital projects, how do I grow as a company? Okay, and all is born from this. So just opposing that to last guy's question, it was the opposite. If the MPC falls, it also affects what? What do we call it? Interest rate. So it has now become more cheaper for the manufacturing companies to get money. So what does that mean? They can procure more machines, and that would help them expand their business. That's how you go about it. So it's an advantage. Okay, so that's one advantage. All right. So even we're told that inflation also fell, so it fits into that. Changes in interest rate might affect what? Spending by customers. So for example, higher interest rate might reduce what? Customer or consumer spending. Why? If interest rates are high, remember that it affects both borrowing and what? Investment. So if interest rates increase and I'm investing, I know that I'm going to get more return. So why would a consumer spend more money? They'll rather invest. So that's why currently we are seeing T-bills rate down, fixed deposit rates down, and so on and so forth. Right? If they are down, I mean, why should I even put money there? Why should I be investing? Because what am I getting on it? I hope that is clear. So if interest rates are rather high, you are going to see that your consumers will be what? Will be investing rather than what? Or they'll be saving or investing their money rather than spending. So currently people will be spending more because, hey, interest rates are lower. So if you just oppose that to what we have here, MPC is falling, inflation is falling, it means that interest rates will be what? To be falling. And so the advantage for us is that people will not be investing or people will not be saving. And therefore, as a manufacturing company, what will they do? They will buy from us. That is it. Okay? That is it. That is what we mean. All right. Inflation rates and a fall in the inflation rate and the fall in the, what do we call it? The MPC, or the fall in inflation means that there's some form of what? Currency stability, which is what we are seeing, right? And so as a manufacturing company, if I may have to buy goods from a supplier outside, it means stable exchange rate for me. Because we've said that falling interest rates, right, or interest rates affects what? Our exchange rate. So if your interest rate or inflation rate is falling, then definitely your CD, your currency will be appreciating in value, making foreign imports what? Less expensive for you as a manufacturing company. That is basically it. Okay, that is basically it. So you just have to mention some of these three things for 5 marks in your exam last night. I hope this is clear. So please, the things we are doing, they are as practical as possible. All right, any question, please?